Every government claims it serves the people. Every politician promises stability, prosperity, and growth. But behind the speeches, behind the campaigns, behind the theater we call politics, there is another force, quieter, more technical, and infinitely more powerful. That force is the central bank. Central banks don't march in parades. They don't shake hands on the campaign trail. Most people couldn't name a single person who runs them. And yet these institutions decide how much money exists, who gets rescued, which banks live, and which banks die. They can make your mortgage cheaper or turn it into a financial noose. They can erode your savings without passing a single law. They can vaporize your retirement with nothing more than a policy shift. And they do all of this without one vote from you. This is the hidden history of central banks, how a handful of institutions became the real power brokers of the modern world. To understand how they rose to this position, we need to go back to the 17th century. Europe was in chaos. Wars drained treasuries. Kings spent money like gunpowder. Governments were perpetually starved of hard currency. And in England, King William III found himself facing a brutal truth. He needed money to wage war against France, and nobody wanted to lend it to him. Lenders hesitated. The crown had a long, ugly history of taking money and never paying it back. So when a new institution appeared, it came with a privilege no private lender could dream of. It could issue notes, paper promises backed not by gold or silver, but by the government's own debt. For the first time, money wasn't simply metal pulled from the ground. It was confidence, confidence in the state's ability to repay. And the Bank of England became both the king's creditor and the nation's banker. The lesson was unmistakable. Control the flow of credit, and you control the state itself. Other nations took notice. Sweden had created the Riksbank back in 1668, but it was the Bank of England that became the model the world copied. Across the 18th and 19th centuries, central banks spread through Europe like a new technology of power, always attached to governments that needed dependable financing for wars, expanding empires, and rising industrial cities. By the Napoleonic era, the marriage between warfare and finance was undeniable. Napoleon's armies marched on credit as much as on gunpowder, and Britain's ability to borrow, through its central bank, gave it the financial endurance to outlast France entirely. The pound sterling, backed by the Bank of England's credibility, became the anchor of the global financial system. Wars were no longer won only on battlefields. They were won in the accounting books of central banks. But the real transformation came in the 20th century. In the United States, the financial system was chaotic and splintered. Banks issued their own notes. Panics erupted whenever confidence cracked. The most dramatic came in 1907, when a Wall Street collapse sent shockwaves across the country. Banks failed, depositors panicked, the entire financial system hovered on the edge of collapse, and the savior wasn't Congress. It wasn't the White House. It was one man, J.P. Morgan. From his mansion library, Morgan summoned the nation's top financiers, locked the doors, and forced them, quite literally, to inject enough capital to stop the panic. One private citizen had stabilized the American financial system more effectively than the U.S. government itself. One man had stabilized the American financial system more effectively than Congress itself. For the political class, it was humiliating and terrifying. America needed an institution that could do what Morgan did, but with national authority behind it. In 1913, after years of debate and clandestine meetings on Jekyll Island, a secluded retreat where bankers and politicians drafted the blueprint in secret, Congress created the Federal Reserve System. The Fed was built to appear independent from daily politics, yet tightly aligned with Wall Street. It could issue currency. It could set interest rates. It could act as the lender of last resort. It became America's new financial engine, privately influenced, publicly legitimized, and almost no one understood how much power had just been concentrated. World War I delivered the first real test. Industrial warfare consumed money faster than nations could tax their citizens. So central banks stepped in. They printed, they issued bonds, they kept governments alive. The gold standard, the old anchor of monetary discipline, was suspended across the world. The lesson was unmistakable. When governments face existential threat, central banks will always write the check. The printing press was no longer an emergency tool. It was policy. By the end of the war, inflation had torn through Europe. In Germany, the Reichsbank, hammered by political pressure, printed marks until they dissolved into nothing. Weimar hyperinflation became the defining example of a central bank destroying its own economy. And yet even that catastrophe didn't stop the evolution. It proved how indispensable central banks had become, for stability or for collapse. It only confirmed that central banks had become indispensable, whether they preserved stability or accelerated collapse. The Great Depression exposed their darker edge. In the late 1920s, speculation pushed markets to impossible heights. When the bubble burst in 1929, the Federal Reserve failed to act with force. Banks went under, credit seized, millions lost their jobs. Economists still argue over whether the Fed's tight policies deepened the catastrophe. But one reality became undeniable: a central bank's decisions can determine the fate of entire populations. Governments paid attention. After World War II, they moved to organize central banking on a global scale. In 1944, as the war still raged, delegates from 44 nations met in Bretton Woods, New Hampshire. Their goal was ambitious: design a new world financial order. The US dollar, tied to gold, would sit at the core. Other currencies would peg to the dollar. The IMF and the World Bank would enforce stability. But behind it all was a simple truth: the U.S. Federal Reserve and the U.S. Treasury now occupied the center of the global economy. Money had become geopolitics. The illusion shattered in 1971. Heavy spending on Vietnam and domestic programs drained America's gold. Foreign nations demanded redemption. President Nixon faced a choice: lose the gold or end the system. He chose to end it. On August 15, 1971, he announced that the dollar would no longer be convertible into gold. The anchor of Bretton Woods snapped. The world entered the era of pure fiat, money backed only by government decree, managed entirely by central banks. The age of restraint was finished. Central banks now had unlimited room to create money, and they used it. The crises of the last 50 years proved it. In the 1980s, Federal Reserve Chairman Paul Volcker drove interest rates to nearly 20% to crush inflation. The result was a severe recession, but also the restoration of global faith in the dollar. By 1980, the Fed had proved it could swing its authority like a hammer. One decision, and the entire economy bent to its will. But that was only a preview of what came next. In 2008, when the global financial system collapsed under its own weight, central banks unleashed power on a scale the world had never seen. The Federal Reserve, the European Central Bank, the Bank of Japan, they didn't just intervene. They created trillions in dollars, euros, and yen to rescue banks and inflate markets back to life. They gave it a polite name: quantitative easing. For Wall Street, it was salvation. For ordinary savers, it was confiscation disguised as policy. Near zero interest rates and soaring asset prices enriched a tiny elite, while everyone else watched their purchasing power erode. Then came 2020, and the process went nuclear. In weeks, central banks printed more money than they had in entire decades. Stimulus checks, corporate lifelines, bailouts for industries deemed too essential to fail. All of it created with a few keystrokes. Balance sheets exploded to planetary scale. Justification? The same word, repeated like a ritual. Stability, the cost, inflation, asset bubbles, and a quiet global realization that money no longer reflects value, only central bank decisions. Here is the hidden truth: central banks are not referees, they are kingmakers. They decide who suffers a recession and who dodges it. They decide which corporations live and which die. They can erase debt through inflation, or inflict deflationary pain with a single announcement. Their decisions penetrate your life more deeply than any election ever will, and they operate behind a wall of complexity: interest rates, liquidity facilities, asset purchases. A maze of jargon hiding a simple fact: these institutions can manufacture money and distribute credit on a scale no private power could dream of. And every intervention expands their reach. Every rescue breeds dependence. Every bailout teaches markets that the next bailout will come too. The result is a global economy hooked on central bank liquidity, addicted and fragile. Governments run record-breaking deficits, confident their central banks will suppress interest rates. Banks embrace reckless risk-taking, knowing someone will catch them when they fall. And the contradictions behind the system grow larger, louder, and harder to hide. Investors keep chasing bubbles, convinced the Fed put will always catch them. But history is ruthless with illusions. The Bank of England lost its credibility in the 18th century. The Reichsbank printed itself into oblivion. The Bretton Woods system, the foundation of global finance, collapsed in 1971. Every monetary architecture, no matter how mighty, eventually breaks. And when it does, the consequences land on ordinary people first. So what does this mean for you? It means understanding that central banks, not presidents, not parliaments, run the real economy. If they inflate slowly, your wages stagnate. If they tighten aggressively, your mortgage doubles. If they rescue markets, asset owners get richer and savers get poorer. It means realizing the entire system rests on a single ingredient: trust. And trust is fragile. If people lose faith in the dollar, in the euro, in the yen, central banks cannot print credibility. They can print money, debt, stimulus, but not belief. It means remembering that true resilience never lives in promises from central bankers. It lives in the things they cannot conjure out of thin air: gold, land, skills, productive enterprises, assets that survive every cycle, every crisis, every monetary collapse. Because the secret history of central banks isn't actually secret, it's written across every bailout, every bubble, every inflationary spiral. Central banks were born to fund governments. They grew by financing wars. They expanded by saving broken financial systems. And today, they sit at the center of a global empire of credit, unelected, unaccountable, and more powerful than almost any institution on earth. That is the paradox of modern money. The people you never vote for control the money you cannot live without. If this shifted how you see central banks, markets, or the financial world you live in, subscribe, because the future won't reveal new answers. The answers are already written again and again in the past.